That Investing podcast is brought to you by the team at Investing Reviews and is sponsored by eToro. Hello and welcome to That Investing podcast. This is our roundup of the week for 20th of October 2023. I'm joined by Charlie Archer. Hi, Charlie.
Hello, Simon. How are you?
Yeah, good. Thank you, mate. Thanks for joining us again. And we've got our senior stock analyst, John Chong. John joins us today. How are you doing, matey?
Very well. Thank you.
Good. Well, this is going to be a quick fire roundup for the week. Hope everybody's listening and enjoying this. So let's start with EasyJet, John, because EasyJet, you put out a share tip price alerts on the website, didn't you, this week at a price target of $5.75. Could you explain why?
Yeah, so it's I know it's a bit of a contradiction with the stock pretty much plunging every single day now and well below the 400p mark. But I still see quite a substantial amount of upside over the medium to long term. And the reason I say that is because the language provided and pretty much the guidance provided by management on its Q4 trading update was actually quite positive. And if you look at the trends from even its peers across the Atlantic, here in Europe, and even tour operators and hotels, anything travel related, everything's been pretty positive. So I don't think that that demand's going to go away anytime soon. There is obviously some risk to be assessed, especially on the fuel front. Everybody's freaked out about the current conflict in Israel and what that could have, what impact that could have on oil prices. But it's worth noting that the airline has hedged almost 50% of its fuel for the full year ahead. So that gives them some downside protection. And with new aircraft coming in as well, that price to book value is going to steep below 1. And I don't imagine a stock with 15-20% earnings growth is going to stay at these levels for much longer. And even in the worst case scenario, you would still see quite a substantial upside in the medium term.
Okay, Charlie, coming from you on that one?
Well, I think that's a reasonable analysis. My concern is the short term, because while the fundamentals for EasyJet appear strong, the short term sentiment is relatively weak surrounding oil. There are a lot of analysts, myself included, who think that if Iran get involved in a regional war, given that they control the Strait of Hormuz, which is responsible for about 30% of the world's global oil supply, you could see Brent go up sort of $120. Now, when Russia invaded Ukraine, that's exactly what happened. Brent went up to sort of 120-ish. It then settled back down kind of 80 to 90, which is kind of in the range where we are now. So over the shorter term, you might find there's a better entry point for EasyJet than there is currently. But over the longer term, I do think that your analysis is pretty accurate in terms of where the longer term investment thesis is. One concern investors might have is that they're looking at almost doubling their fleet of aircraft in order to provide for that growth they're going after. But there is a kind of a nightmare scenario where oil rises, inflation increases, you've got a cost of living crisis, and suddenly you've got a lot of planes which you can't fuel because you can't sell the tickets at the right price. I don't think that'll happen, but there are several investors who are looking at that with a lot of fear. And therefore, you're looking at that sort of that short term, the share price is dropping. A year from now, I think it'll be much higher than where it is today. But if you're looking at investing today, there might be a slightly better entry point over the next week or two.
Okay, great. Thanks for that insight, Charlie. And John, what about Deliveroo? John, there was something happening with them this week, yeah?
Yeah, so they released their Q3 numbers. It was pretty much bang in line with estimates, arguably a little bit better than what most people have expected given the cost of living crisis. But what you will notice is that most of the good news is being priced in on the profitability front, or at least on an EBITDA basis, because top line isn't growing as much as one would want it to grow at. And part of the reason for this is mostly just cost savings and the optimization of delivery routes and whatnot. In terms of spending, what you've seen is pretty much a tapering off in average monthly active customers, and even monthly order frequencies just staying stagnant. And it's been stagnant for pretty much 2 years now, and since its IPO. So whether Deliveroo is going to head back up to that 390p IPO price that it debuted at, it's highly unlikely, at least in the medium term. But there is some upside to be realized if they can get those order numbers going again. But for now, it does look bleak with the cost of living crisis, I would say.
Yeah, but I would say, okay, the average monthly active consumers, there were 7.6 million in Q1 2022, height of a pandemic, and now there's 6.9 million in Q3 2023. That's not such a bad shedding of customers when you take into effect all of the headwinds. And then, yes, the average monthly order frequency of 3.4 has remained completely unchanged over the past 2 years, as you say. But then I look at that and I go, well, okay, that's not showing growth, but in the current economic conditions, that's not bad either. And then if you think, okay, the monthly orders are staying the same, you've lost some consumers, but to be honest, the growth was so high during the pandemic that was relatively, that was going to happen regardless. And then you've got gross transaction value rising as well. I think that Deliveroo has got a decent forward guidance, I would say. I think it could rise pretty sharply over the next year or two when sentiment comes back to the market. The only thing I would say, there's a capital markets event on the 29th of November to watch out for.
Yeah.
The one thing I would say, Deliveroo decided not to hold a conference call or webcast for analysts to chat to them and talk to them, which is, in the markets relatively unusual. Maybe they didn't feel there was enough to be worth discussing, but I think long-term investors, there's nothing wrong with just having, half an hour out of your day to have a chat. I think that's reasonable. And the fact they didn't do that was, for me, relatively disappointing. But that's only a small point in a wider case.
Yeah.
Okay.
If I could just add a little bit more onto that as well, actually.
Please do.
So I mean, Q1 and Q3 normally, for at least for this year, Deliveroo didn't report sort of like an earnings call. So
yeah,
I think that it's just one of those things. But I will say that moving forward, that there is a risk for market share deterioration, because you've got Uber Eats, who's just ramping up promotional discounts. And in fact, as a user myself, I use Uber Eats more than I use Deliveroo now, despite the better interface on Deliveroo. And what you will find is that because most of Deliveroo's restaurants are on the higher end of the spectrum in terms of prices, rather than your local chicken shop around the corner, in this cost of living crisis, which is why you might see that lag in terms of orders and whatnot. But moving forward, I think they would have to really ramp up their proposition on the customer front, whether that's through advertising or groceries or whatever it may be that they choose to do. It will have to rival Uber's really strong proposition. And don't forget that Uber Eats does have a bigger parent company backing them. So they've got synergies and expertise that Deliveroo probably does not have necessarily.
Yeah, that's true. And I guess obviously Uber, you've got the ride-hailing service as well. So you've got that kind of cross-selling that you have. I have the Uber app, I have the Deliveroo app. Uber will constantly, I don't use the Uber ride-hailing because I'm just not in the right area, but they'll constantly send you a ping, use this, use that. And I imagine it's cross-optional. Wrapping up on it really quickly, I do think that one of the other things that aren't really mentioned is that all of the food, whether it's Deliveroo or Uber Eats, is delivered by and large by self-employed freelancers. Yeah. Anecdotally, I think Uber Eats are paying slightly more per order. So Deliveroo could see its margins squeezed a little bit more. And again, because Uber has got that financial backing, it can do that. That puts Deliveroo in a little bit of a tight spot, margins-wise.
Yeah, okay, interesting insights there, Charlie and John. Thanks for that. Why do we wrap up, Charlie, on the CPI index? Tell us what's been going on that this week.
Okay, so CPI came in at 6.7% for September. Analysts had thought it would drop slightly. 6.7% is flat month on month. There's a couple of really interesting things going on here. Now, the first is that 6.7%, and this is my perspective, is still more than 3 times the Bank of England target of 2%. Okay, so it's still very high inflation on top of what has already been high inflation. You kind of get the sense that obviously it topped out at 11.1% around this time last year. So having dropped to 6.7, it's relatively low. It's not, that's just your comparative bias. The second thing is that next month you're likely to see a relatively steep fall in CPI because of Ofsted price caps for domestic energy bills. They take up quite an outsized proportion of the CPI calculation. And because the bills for the average household are going to go down next month, that's almost certainly going to drop CPI. The problem that you have is, again, because of this Middle Eastern situation, if oil starts rising as we go into the colder part of winter, you can see, inflation drops quite sharply because it's kind of predestined to next month. And then thereafter, it rises quite sharply because the effect of rising oil prices push inflation back up. So you might get this situation where the Bank of England or the Federal Reserve, all of the central banks go, well, okay, well, the CPI is now dropping quite well, but actually that's not the case. In America, inflation has risen the past couple of months after they thought it was defeated. In Australia, it's been rising for the past couple of months as well. So I guess my perspective on it is that it's 6.7%, even though, is still quite high. And even though next month, I think it's quite likely that it's going to drop quite steeply. Even if it dropped to 5%, that's still more than double the target.
Yeah, interesting there, Charlie. Thanks for that. John, quick comment on that before we wrap up?
Yeah, so most of the media headlines are going to tell you that headline inflation probably stayed flat because of oil prices. And while that's true to some extent, I think the media has probably also missed out the fact that it's mostly contributed by services inflation, which actually ticked up in September. By I think 10 basis points. And that's probably because you've got higher inflation from recreational and culture. That's your concert activities and whatnot. And you've got restaurants and hotels who went up as well. That went up as well. So that's probably because of wage growth. Now, wage growth is tapering off. And that was pretty much shown in the 3 months to August, I think it was, earlier this week's in this week's earlier data. And it's going to take 6 to 9 months for that to impact inflation. So that curve is just starting to peak, and we could still see some upside risk on the core and services front. And hopefully energy prices stay low enough to offset some of that. But I still think over the medium term, it's still going to take a little bit longer for inflation to get down to that 2% target.
Yeah, absolutely, John. Thank you very much for that, guys. That was a great roundup of the week. Good luck this weekend. Weather's not looking great. We're in the middle of Storm Bobette. So stay safe, everybody, and have a great weekend. Thank you for listening to That Investing podcast, brought to you by the team at Investing Reviews. Check out our latest stock market news and analysis at investingreviews.co.uk. You can also find us on Twitter and LinkedIn. Just search for Investing Reviews.